Carrying forward tax losses and offsetting them against future taxable income. In the realm of corporate taxation, businesses may incur losses in a given tax period. When these tax losses occur, they are not necessarily a permanent setback in terms of tax obligations. Taxable persons, businesses or individuals subject to tax, are allowed to carry forward these losses and offset them against taxable income in subsequent tax periods. This provides a means for businesses to reduce their tax liabilities in future periods, particularly after experiencing a temporary downturn in income. However, the ability to carry forward tax losses is subject to meeting specific regulatory conditions, and there are limits to how much of the loss can be used to offset taxable income in a given period. These conditions ensure that tax relief is applied fairly and in line with the intention to tax the business on its overall economic activity over time. Conditions for carrying forward tax losses. Taxable persons who have incurred losses during a particular tax period may carry these losses forward to offset their taxable income in future periods, subject to certain conditions. One of the key limitations on using these tax losses is that they can only offset up to 75% of the taxable income in the following tax period. This limitation ensures that the business is still subject to corporate tax on a portion of its income, even after applying carried forward tax losses. For example, if a business has AED 1 million in taxable income in a subsequent period, and it carries forward a tax loss of AED 900,000, it will only be allowed to offset 75% of that income, which would be AED 750,000. The remaining AED 250,000 in taxable income would still be subject to tax. This ensures that the tax system remains fair, applying taxes to the economic activity of the business as a whole, rather than allowing for complete avoidance of tax by carrying forward large losses. Furthermore, businesses must use the available tax losses from a current tax period before they can carry forward any remaining losses to subsequent periods. This means that if the losses carried forward from a previous period are less than 75% of the current period's taxable income, the business is required to fully apply those losses to the current period's income. This prevents businesses from choosing to defer the use of losses, ensuring that the losses are used as soon as possible. It's important to note that tax losses cannot be carried back to offset income in prior periods. Losses can only be applied to future periods, ensuring that businesses are taxed based on their overall performance over time. Example of carrying forward tax losses. To illustrate how the tax loss carry-forward mechanism works, consider the following example. Example, carrying forward tax losses. C LLC is a UAE resident company. In the tax period ending 31st December 2026, C LLC incurs a tax loss of AED 6 million. The company's financial situation improves in the following 2 years, and it generates taxable income of AED 5 million per year for the tax periods ending 31st December 2027 and 31st December 2028. Here's how C LLC would apply its carried forward tax losses. Tax period ending 31st December 2026. C LLC makes a tax loss of AED 6 million, and no tax is payable for that period because there is no taxable income. Tax period ending 31st December 2027. In this period, C LLC generates taxable income of AED 5 million. According to the rules, C LLC can use 75% of this income to offset against its carried forward tax losses. Therefore, the maximum tax loss that can be applied is AED 5 million by 75% is equal to AED 3,750,000. This leaves a final taxable income of AED 5 million, AED 3,750,000 is equal to AED 1,250,000. CLLC must then pay corporate tax on the remaining taxable income, which is AED 1,250,000. Assuming the tax rate is 9%, the corporate tax due would be AED 1,250,000 by 9% is equal to AED 112,500. After applying the tax loss, CLLC has AED 2,250,000 in tax losses remaining, AED 6 million, AED 3,750,000. Tax period ending 31st December 2028. In this period, CLLC again generates taxable income of AED 5 million. The company can again offset 75% of this taxable income with the remaining carried forward tax losses. The maximum tax loss that can be used is AED 5 million by 75% is equal to AED 3,750,000. However, since CLLC only has AED 2,250,000 in remaining tax losses, that full amount is applied against the taxable income. The remaining taxable income is AED 5 million, AED 2,250,000 is equal to AED 2,750,000. CLLC now owes corporate tax on the remaining taxable income. The tax payable would be calculated as follows. Corporate tax on AED 375,000 at 0% is equal to AED 0. Corporate tax on AED 2,375,000 at 9% is equal to AED 213,750. Thus, the total corporate tax payable for the tax period ending 31st December 2028 is AED 213,750. After applying the tax losses, CLLC has no tax losses remaining to carry forward.